Good morning. I'm Kirill Ilinski. I'm managing partner of Fusion Group. Welcome to our inaugural session of Fusion series. We want to create an educational webinars where we talk about key concepts and most interesting bits in investment management. And so that you are not too tired of us seeing us every month, every time, we decided to invite people from other firms who are doing interesting things and give them opportunity to talk about their favorite subject. And hopefully that will be interesting for you and you will learn new things and see new faces. The first webinar we decided to do about factor investing. Factor investing became very, very popular. There are a couple of Nobel Prizes linked to it, and it became very, very popular among the fundamental investment community. Basically, factor investing answering the question, what drives the returns? Different risks coming with different risk premiums sometimes zero when you don't need this risk, and how to think in different markets, in various market environments, in terms of overloading this risk or that risk, and how much you will be paid for that. So today, we invited our colleagues from Vanguard, Ben and Joao, to speak to us about factor investing, with a particular emphasis on small cap size factor, partially because it's super interesting, partially because of the current Trump situation where there are new barriers rising across the countries and that favors local businesses. Local businesses are typically not super huge and fall within this small cap bit. And partially because we have Vanguard small cap in our Fusion portfolios, and James at the end will be speaking how we're using this and what's the rationale. So I'm passing button to Ben. Thank you.
Look, thank you very much for having us today to the Fusion series. We know this is meant to be heavily educational. It's great to have Vanguard along to speak to you all. What we're going to talk to you about today is a little bit around factor investing, and then with a focus on small caps, that kind of size factor. I think with the rise of deglobalization, historically high stock concentrations across major indices, a lot of tech domination, and then a man called Donald probably causing a few ruptures too. This is probably an interesting time for all investors. And it's probably a time when you're thinking about, how do I diversify my risk? How do I capture some of these changing trends in the market and some of these global market dynamics? The purpose of today's session is to give you a little bit of a history lesson around factor investing, and then bring to life small caps as one of those factors, the size factor, as an asset class, and explore how you can capture that effectively, which we'll be doing with Kirill and James at the end. In terms of the running order today, I'll do a little bit on factor investing at the start. I've also got my colleague with me today, Joao. Good to have you along, my friend. And we'll be talking a little bit around small caps, why global, and then a little bit on indexing as well. So my job today is to probably ask the occasional cutting question on behalf of you, the investors. And I will probably be doing that ad hoc throughout. So let's start with factor investing. What is factor investing? Like I said, we know the Fusion series like to be educational and should be educational. We always believe that these things should be rooted in education, not in product pictures. And that's certainly what we want to do today. So before we dive into small caps, what is factor investing? Well, factors are specific attributes or characteristics that can influence the performance of securities or stocks, and help explain the differences between different stock returns. Maybe not all the differences, but quite a lot of them. And factor investing is effectively an investment strategy which involves selecting the securities based on these specific attributes and factors. Now, that's a very basic start. I guess the natural next question is, well, why are they important? And I guess a brief look at history probably helps in that regard. So if we cast our minds back quite a long way back now, and we start to try and understand how the understanding of returns has altered through time, what we're showing you here is that in pre-1960s, pretty much any return you got within your funds that you're investing in, everyone thought it was all manager skill, probably a nice time to be a manager. You're getting 100% of you're basically effectively getting 100% of the credit. Then fast forward to 1960s to about 1975, what people started to realize through the capital asset pricing model, which we'll go into a little more depth on the next slide, is the market actually makes up maybe 80% of the return you're getting. So the beta in the market, and then maybe there's some manager skill on top, maybe that final 20%. Obviously that number can fluctuate a little bit, but you get the idea. The market was the main driver of return, not the manager's skill. I think we've probably seen quite a bit of that in the last few days. Then 1976, a bit of a seminal moment. What you had there is effectively factors being discovered. So data started to come out around what these factors, these underlying characteristics and attributes of stocks could be doing to driving the different returns in stocks across the market. You put these three things together, the market, factor exposures, and then manager skill, you get to that 100% of the pie. The really interesting thing here, though, and you will all have noticed this, is manager skill has become less and less important effectively. Factors and market are far more the dominant pieces when it comes to what's going to be driving you and your clients' returns moving forwards. So, as I've said, factors are characteristics and attributes that explain differences in stock return, and there are a fair few common factors out there. They include value stocks, so effectively stocks with low PE ratios, size. Principally, what we mean by that is the data suggests that if you invest in smaller companies rather than larger companies over long periods of time, that will probably benefit in extra return. There's also momentum, quality, low volatility. There's a fair few others out there too. These are probably some of the most common named ones out there. As I said, though, we have been through a bit of a journey throughout this period, starting off with pre-1960s, no factors, no understanding of how market returns are really coming, where they're really coming from. Then dive into the capital asset pricing model. 1960s, you start realizing the market is probably driving quite a lot of the return. Arbitrage pricing theory, which is done by Stephen A. Ross, it basically proposed that multiple factors could be. So that's your moment. That's the moment when factors become a thing effectively. 1976, Stephen Ross says that maybe multiple factors are actually driving some of this return. Then you have Sanjoy Basu. He's going to turn up and say, I've actually isolated one of these factors now. So now we kind of believe they were there. I've isolated one of them, the value factor. So stocks with low price to earnings over time are probably going to outperform stocks with high price to earnings. Kind of common parlance to that. Valuation is a great starting point to understand exactly where future returns are going to come. We still believe that today here at Vanguard. Starting valuation is absolutely critical. Not the only thing you can look at, but it's a very good guide for long-term returns. Now, very pertinent for today, the size factor. We're going to be talking a lot about small cap over the next few minutes. Rolf Banz identified the size premium, and he effectively said that smaller companies are probably more likely to outperform than larger companies over long periods. Now, there may be risk involved in that, but typically there was a size factor in place. So you've had those early beginnings, you had that initial discovery. Now we're going to move on to the factor expansion, and this is where the research really starts to kick into gear. Most famously, many of you on this call will have heard of Farmer and French. Back in 1992, 1993, they launched a three-factor model. So effectively, they added in size, value, and market into one model to try and equate what was driving stock returns. You then had Titman and Jagadish. That's not so easy to say, is it? They found that the momentum, again, so stocks that have been heavily traded from a positive standpoint typically continue to be heavily traded from a positive standpoint and continue to rise. They found that in 1993. Now, there's been obviously lots of research in between times, but there have also been some modern developments. We've had additional factors added in, low volatility, quality, liquidity being some of those. And really interestingly, almost 2 decades later, Farmer and French made the 5-factor model, adding in profitability and investment factors. And I know Joao's got some great slides which are going to show you how that comes to life later. Hopefully that gives you a whistle-stop tour of what factors are, some of those common factors and how we've got to where we are today, but they're important drivers of market returns your returns going forwards. And they're kind of potentially some of the unseen hand, and hopefully we've kind of showed you that today. I guess the next thing is we're going to focus on the size factor today and being small cap and how you can kind of access that and the benefits of going global. So with that, I'll bring Joao into the conversation. Joao, welcome. You've been patiently waiting.
Of course, thank you, my friend. Thank you for asking me, and thank you for everyone that will watch this. Hopefully, as Ben is already doing a great job there, hopefully it will be insightful and you can learn from what we are trying to say today. We do have a lot to cover, so I will count on you, Ben, since you are sharing the deck to help me navigate through the slides in an effective way. And we are going to try, in addition to what Ben has been discussing, talk a little bit about why small caps in the current environment, also why going global is important for small cap investors, and then in the end we are going to have a little bit of a discussion on the product side. So why small caps at the moment? And of course, as Ben mentioned, Donald Trump is in everyone's mind, but the situation behind small caps attractiveness was already playing out. And one of the main reasons why small caps are coming to mind to investors is that the valuation discount is at a two-decade record. So even before the tariffs were announced, if you look at the valuation of global small cap against the global broad market, you can see that small caps have been derailing. And this has been happening for almost 20 years, and it has only accelerated in the last 2 to 3 years. Is this because small caps have a specific sector tilt, or was there a particular sector that led to the downfall of small caps? And the answer is no. The reality is the discount has occurred because small caps across board have seen a derating. So investors haven't really been looking at small caps as a great proposition. You can see that communications, energy, materials, pretty much every single sector on the small cap front has seen a derating in valuations, which is the flip side of global broad. If you had stayed invested in the last 20 years in global equities, so large cap, you can see that pretty much every single sector outside of energy and utilities has seen a positive momentum. So next slide. How has the year to date situation evolved? We have seen a derating across the board. So again, this is even before Trump has announced tariffs. If you were to update this valuation slide, considering what happened last week, the derating would be even more pronounced. And what you can see just by comparing blue to red, which is blue what we had by end of December, red what we have now, is that even after the derating, US growth, US mega cap, US technology is still trading at very elevated valuation levels. Yes, the market has corrected. Yes, you would have experienced strong negative returns on ongoing S&P 500 or US mega cap, but compared to history, which is our gray bar over there, historical trading range, US growth is still looking expensive. Developed market small caps, our global small cap proposition, after the derating is now trading at the lower end of its historical trading range. So small caps valuation are attractive both from an absolute and relative basis. Now, the other very important point to bear in mind when we think about small caps is the diversification argument. And it won't be the first or last time that you hear Vanguard talking about diversification, but we do it and we say it because it's super important for investors. Just focus, for example, on the top 10 names of MSCI World, or let's call it developed market core allocation, and the equivalent, but on small caps. The top 10 names of MSCI World, even after the derating, even after Trump tariffs, are still accounting for close to a quarter of the full exposure, so 25%. It's completely different when you try to harness size by going into small caps. You have a concentration at around 2%. So straight away, your single name dependency is much less pronounced, which is important, especially when you're looking at the news and you're seeing the headlines, Nvidia down by X%, Tesla down by X%. Now, more than ever, is not a time for you to have a single name driving your returns because it's so unpredictable what might happen. Each company will have different supply chains. Each company will be impacted differently from whatever happens in the US and the potential trade war. So with small caps, you are more diversified and less concentrated at individual names. So
thanks, Joao. I also think an interesting point here is that mainly small cap names will probably be more domestically orientated as well, and that could be a benefit in this world we live in of high tariffs and trade wars.
Agreed. Good point. Let's go to the next slide. And not surprising, but it's always good to have an idea just how big we are talking about of the differences. If you go broad, so let's say your core beta allocation, you go global equities broad, you're really going mega and large cap. And this is something that a lot of you will know. Some of you might come as a surprise. It's completely different from when you go to small caps, where you have only approximately 10% of your allocation into companies deemed to be large. I know this might sound contradictory. Okay, I'm going into small caps, but I have large, I have a lot of mid cap. This is based on the definition of market cap. We are using what is the market consensus. We call large cap what is above $10 billion, but it's a day and night exposure from when you go broad. So by going small cap, you are much diversified on a cap size exposure. And also you have a much broader exposure. We're talking about 4,000 securities versus, I believe, 1,300 on the global core allocation. In addition, if you may, Ben, this is also a country diversification story. You are diversifying away from concentration risk on given names. You are diversifying away from size cap. You're also diversifying your country allocation away from the US. So what we are looking in here is the net weight of country and sector, looking from a small cap perspective versus broad. And US is still going to be your biggest country allocation. US is still going to be around 60% versus 70, but you are diversifying. And the biggest underweight is going to be US tech. So if you focus all the way to the bottom right, you have 20% underweight compared to broad market on US growth names, which if you are trying to harness size, that's exactly what you want. You want to be closer to a small cap play, but also maybe to value, another factor that Ben mentioned. We are not suggesting small cap is a value play, but just by being underweight growth, you are removing some of that skew that you have in broad markets. In addition, super important, you have more industrials, you have more real estate, you have more basic materials, a different sector allocation. Where is the main proportion coming from? Japan. And we will talk a bit about Japan today. Japan is in a different economic cycle. Whereas for 2 decades, Japan was struggling to grow, and we saw how the Abe back in his day and consecutive Japanese government bank governors were using extra loose monetary policy to try to reignite the economy. They were fighting deflation. It was a fight that lasted 2 decades, but now we are finally seeing inflation to pick up, interest rates to come high, and there is talk, and hopefully that is the case, of renewed momentum in the Japanese economy. Next slide.
Great, thank you, Joao.
One last point before we move from why small cap into why global. Does size factor really have, let's call it, evidence or backing from an historical perspective? And the reality, yes. If you focused only in the last 4 years, no, you'll probably be very upset that you were allocated into size cap rather than broad, because US mega cap names really delivered strong returns, which is not the case for for small caps. But throughout time, the longest available period we have since 2001, you can see, given by the gray area, that global small caps have outperformed global equities. And even though we have seen let's call it a struggling period in the last couple of years, there is potential for that to reverse.
Perfect, thanks, Joao. And I guess on the natural next question is around how do you allocate to this area? I mean, many people we see doing it regionally, many asset allocators we see some benefits in global. It'd be great to hear your thoughts on that.
Of course. This we can skip and then we can revert back. So why global? It's a very good question, Ben. And if we understand how diversified and how broad small caps are, I think hopefully this slide will be easier to understand. What are we looking at? We are looking at an efficient frontier assuming a portfolio of 4 different building blocks: US small caps, European small caps, Japan. The reason why we pick these 3 is they are the 3 largest components of global small caps. And then you have developed market small caps, your MSCI World Small Caps. All the blue dots that you are seeing are the different levels of historical volatility realized and historical realized return per unit of volatility. So by combining all of these 4, what type of, let's call it risk-adjusted return, what type of Sharpe can you get, or would you have gotten historically? And you can see there is a trade-off, right? So if you go US small cap, this is where you have the biggest volatility. If you go to Japan, it's the lowest volatility of the individual building blocks, but also at the return cost. It would have been the worst single building block for risk-adjusted returns, the lowest Sharpe. The very important point to take from this is that historically, and we are looking at 23 years, going global with small caps would have been your almost most efficient, your best risk-adjusted return strategy. Why? Because not only can you benefit from US small caps higher returns, Japanese small caps lower volatility, you also have exposure to Australia, to Canada, to other countries outside of Europe, outside of US, outside of Japan. And it has proven to be historically mean variant efficient. You could have probably optimized it even further by maybe by being 98% developed and then a little bit of Japan, but you have to consider the transaction costs of going in and out of regional allocations. And this is another layer. From a cost perspective, just going broad and keeping it as a long-term investor would have been historically mean variant efficient.
Fantastic. So global small cap seems to be the best way to efficiently capture the size factor.
Yes.
That's what we're saying.
Correct. And why is that? This is just a simple representation because, as I was saying, you can capture Europe and US strong returns, Japan's lower volatility. The correlation between them is also less than perfect, something that you can see on the previous slide. Even though they are, of course, strongly correlated, you have a less than perfect correlation. Combining all of them can reduce volatility. And that's exactly what you see. Return-wise, 10 basis points less than Europe per annum, but look at the volatility level. You have almost 200 basis points less vol. So all in all, it has been a great risk-adjusted proposition.
Fantastic. I guess we maybe a natural place to actually finish here, Joao, just looking a little bit around, taking us back full circle into factors. So if you want to talk us through this chart, because it's a little bit dizzying for the first time we see it.
Of course, and you have already done a great job in introducing a lot of these factors, so I'll take that cue. And what we are trying to understand is, do we really capture factors by going small caps? And since we are talking about going global versus staying invested in the US, we are comparing how both MSCI World Small Cap and Russell 2000, the US small caps, which factors do they harness, and is it something that is statistically significant? Does it really matter in terms of returns versus the market, for example? So which factors are we considering? We are considering size, value, momentum, investment, and profitability. Ben has already mentioned momentum. He has already mentioned, Ben has mentioned size and value, so I won't go into that. Momentum, so the theory that winning strategies minus losing strategies or stock performance should lead to outperformance, should lead to excess market returns. Profitability, that companies that are profitable should outperform the broad market versus companies that are not. And then we have investment, which we are defining as aggressive minus conservative. So companies that more aggressively invest back into their business should outperform the broad market when compared to companies that are more conservative. Looking at the two, the first thing to bear in mind, then focusing on the table on the right, all the green, let's call it buckets that you're seeing are factors that are statistically significant. There is historical evidence to say that these factors have a contribution to returns. What is in red are those factors that are not statistically significant. So size shouldn't be a surprise. Size should be a factor that we are capturing in small caps, and we are, both on Russell 2000, also on MSCI World Small Cap. So if you invest into these exposures and smaller companies outperform larger companies, we should outperform beta. So we have seen that play out. The first big difference is by going global, and this is because if we think about the different components of global small caps, US would have been your, even at a small cap level, more growthy exposure. That's why on the Russell 2000, you have a positive tilt towards value, but not really significant. If you go global, you also have Japan. You also have Europe. You have other regions that have a more of a value tilt, and you have seen it play out in history, meaning that if, let's call it, value companies have outperformed growth in certain periods, by going global small caps, you outperform the broad market. Other important key takeaway is that you are exposed to negative profitability. So you are exposed to companies that they don't have a lot of profits to show for. Where is that coming from? Predominantly the US. That's why you see the different levels, the 5.16 on MSCI World Small Cap versus 782 in Russell 2000. US companies, small caps, a lot of these companies are companies that are trying to grow. They are leveraging their balance sheet. They might have not shown a profit for a couple of months or even years, but they are aggressively pursuing growth. So if you go small cap, you're not really going to the, let's call it, profitable segment of the broad market. And at last but not least, you also have positive investment. So, and this is something that you could argue you want in a small cap exposure. You want to be exposed to companies that are trying to grow, that are concerned about their growth, and that are trying to pursue it by aggressively reinvesting their profits. So this is what you get. So not only size, that's the key takeaway, not only size do you get by going global and by accessing small caps, but other important factors have explained returns in the last 20 years.
Fantastic. Thank you, Joao. I'm conscious that we're probably running up on time. I hope you found that interesting. I hope it brought to life maybe the world of factors and the world of small cap in a little bit more depth. And I know we'll be back to speak to James and Kirill in a bit. Cheers.
So my name's James, and I'm one of the portfolio managers at Fusion Asset Management. Thank you very much for your presentation. I'm sure the listeners would have found it insightful and interesting. I've just got a couple of questions which I'd like to ask you guys. So firstly, in the literature on factors, they're usually captured by a long-short portfolio. So a portfolio which is long the factor attribute in order to overload it and short the opposite. So this isolates the factor and removes the effect of other factors. For example, the size factor is captured by a portfolio of long small caps and short large caps. So how effectively are you able to capture and replicate this in your long-only fund?
Yeah, sure. Hi, James. Thank you for the question. So as we showed, I think on the slide that we look at factors, it's trickier, right? To your point, when you're doing arbitrage, when you're doing long short, you can pretty much leverage your factor capture. That's essentially what we're talking about. However, by focusing on the small cap end, we have shown historically that we capture size, right? So to your question, if we hadn't been able to do it effectively, your size factor on that chart where we're talking about fund and friend should be either non-statistical significant or even potentially negative. But just the significance of it, it's far beyond 95, 99% levels, means that it is still possible to do it with long-only exposures, and we have been able to do it in our side. The other thing that is important to bear in mind is you are right to say that long short it has been historically a way to capture it, but you have to consider on the transaction costs and to run, for example, a short strategy as well, the margin that you are going to be asked, how rebalancing is going to work for those. So there are added, let's call it added difficulties that once you consider all the transaction costs involved might actually detract some of the factor that you're trying to capture and its impact in performance as well.
Okay, yeah, that makes sense. Thank you. So next question. So recently Goldman Sachs actually released their Market Know-how 2025 QT document, which I was actually reading yesterday. And one of the themes which they identify is this reindustrialization, more domestically focused, a sort of anti-globalization theme, if you like, which we've been seeing happening, which is primarily driven by the US with their America First policies, and now obviously the tariffs and subsequent trade wars have exacerbated this theme. And one of their points is that one of the main beneficiaries of this theme is small caps, as they have a greater domestic focus, less exposed to global trade, etc. And they also benefit from a falling rates environment, which we're in at the moment, due to the higher rate sensitivity relative to large caps. So we're definitely with you on the small cap investing case at the moment. However, Goldman Sachs go on to identify that within small caps, active managers have actually been able to outperform passive managers or index solutions within small caps over the last 1 year, 3 year, and 10 year. I think over the 1 year and 3 year, it's about 3 or 4% per year. Whereas if you compare that to large caps and other asset classes, there's been no outperformance from active managers. So one of their points is that it shows that there's an inefficiency, if you like, in small caps that can be exploited by active managers, knowing the companies, being more nimble, etc. So what's your take on this as index investors?
It's okay. I was smirking a little bit because, well, it contrasts with the evidence that we've also been seeing. Ben, do you mind sharing that slide if you can?
Yeah, absolutely.
And look again, I'm nobody to question Goldman Sachs resources and what they've been using without having seen the report. I'm able to comment on the type of data that they are seeing, but we have actually accessed Morningstar, which of course captures a lot of the mutual fund universe, and it's quite a big, let's call it, library to capture data from. And in their active passive barometer, year-end 2023. So of course, if Goldman is talking about last year, we don't have that data in here. But looking at data as of end of 2023, it's the reverse that we are seeing, right? So in the US and European small cap space, which are the biggest components, so if you combine them together, we're looking at 73% of global small caps universe. More than 84% of active funds have underperformed over 15 years. That's on the US side, which is the largest. If you go to Europe, it's 87%. So I don't know if time frame is something. We always like to go as long as possible. Yes, you can have periods of outperformance in 1, 3, 5 years. Yes, it's true. What data is showing is that in 15 years, if you are a long-term investor, potentially you are looking to have an allocation for 15, 20, 30, whatever many years, that's exactly the opposite. We don't see consistent outperformance. So much so that not only have active managers struggled to outperform in these regions, look at the survivorship rates. Less than 40% in the US survive the period. So the classic example could be you have 3 years of strong outperformance, then you start underperforming, and then you close shop and you start a new shop. And this is important because investors also, even if they have a lot of data and a lot of access to try to find the winners and get the winners and not the losers, will suffer from this. So actually, evidence has shown us that it's very, very hard. Yes, 15% have outperformed in 15 years, which is great. Hopefully, investors would have been able to stick with those 15%, but the vast majority have underperformed in a period of 15 years or more.
I think it's a great answer, Joao. And I think the only thing I'd add to this, to your experience of working with a lot of discretionary portfolio managers like yourselves, is that there's an awful lot of clients who will invest regionally. Japan, Europe, US separately in the active space, in the small cap space. And that is a perfectly plausible, reasonable thing to do if you think you can find the right managers. The benefit of holding a global small cap index fund as a core means it kind of takes away some of that risk. We're not saying it's impossible. The numbers aren't 100% here. That would be pretty much as impossible. I think the US large cap market, probably not far off that. But this global small cap solution, or investing in global small caps, one, captures something that most small cap managers can't do. It's very difficult to be global small cap manager and be active. It's just too many things, too many rocks to turn over, too many areas to be an expert. But also, this going global, if you are going to go active in the regions, covers you if they get it wrong. And we know that there is active risk in any decision you make. This helps kind of mitigate some of that. And we always feel that taking that globally diversified approach is a great starting point. Not the ending point, but it's a great starting point.
Then finally, to finish off my questions, obviously one of the trademarks of Vanguard is the low fees which you guys are able to charge on your funds. And you've explained this to me before. However, for the benefit of the listeners, can you explain how Vanguard's unique ownership structure allows you to charge these low fees and consistently reduce them as well?
Yeah, great question, James. I'll take that one, Joao. So Vanguard is, everyone can say they're unique. Vanguard can truly say, I suspect, we're the only mutual asset manager that we know of on the planet. So every other asset manager is either owned by partners or a very wealthy family, or it's listed on the stock exchange, or any other myriad of different ways you can set up a business. But Vanguard is the only mutual that we know of. Now that means that our investors effectively own Vanguard. So people investing in Vanguard funds own Vanguard. We have no second mouth to feed. Every other business model, there's nothing wrong with those business models, but they do have a conflict of interest. They have they have an owner, and then they have their investors, and they're typically two different people. With Vanguard, our investors are our owners. We only have one mouth to feed. We only have one person to think about. So when we make a profit, if you're in another company, what happens is you make a profit. Who do you think gets the money? The owners, dividend payouts, whatever it may be. When we make a profit, as the second largest asset manager on the planet, about $10 trillion under management now, we typically do make a profit. We give that back to our owners. How do we do that? We lower the cost of our fees over time. So effectively, you get your dividend or your mutual payout by us saying we're going to charge you less for exactly the same service. And what we've done over time, when we joined the market 50 years ago, pretty much to the day actually, we came in and we were about 59 basis points. The market was at about 69 at that point, so we're a little bit below the market. Fast forward to today, the mutual structure and action, so us reinvesting by lowering the cost of investing for investors, giving it back to our owners. The market average now is somewhere around about the 50 basis points mark globally. we are now down below 10, so you're about 0.07, I think, globally we charge. That's our mutual structure in action. That's how we continue to do it. And I think, and the last important point on this is every single Vanguard fund washes its own face. So there is no cross subsidy. So our big funds aren't cheaper because so our more popular funds aren't cheaper because we're charging a really expensive fee to someone else over here. Everyone gets a fair deal on whatever they buy. Whatever it costs us to run the fund, we will give to our investors. So I think the main takeaway from that is that our pricing is sustainable on each product, so you're unlikely to see a price rise. And two, it's for your very best interest. You're getting the best possible deal we can give you on any product you buy, and someone else isn't missing out. You're not missing out for someone else's gain.
And just one last point, if I may, Ben. And this is independent of who's in charge. And the biggest example of that is even this year, we have changed the CEO. It's the first time we have an externally appointed CEO, came from BlackRock, Salim. And after he joined, we went on one of the biggest cost-cutting exercises in our history. So it's the philosophy of the business. He will probably, as any new CEO, will try to implement changes, will try to have his own personal branding involved, but this doesn't change. That's our focus, has always been our commitment, and even the market, after knowing us for so long, still got surprised with just the size of our reduction in cost in the US and across the globe. So this is something that will never go away, and it's very important to bear that in mind.
And I think, sorry, I know it's a bit long in answer now, but I think one of the really interesting things is something called the Vanguard effect. When a Vanguard joins the market, the price gets cheaper for everyone to buy because we come in at a low sustainable cost. We keep it there. We continue to lower it. Other people obviously have to compete with that, and they have to lower their cost in order to attract assets. So everyone gets a better deal, and that's kind of laid the foundations for actually Warren Buffett was saying that the American investor, you should probably say the global investor, if there was going to be a statue built for anyone who'd built an asset management firm, it should be our founder, Jack Bogle, who has a statue built because the amount he's done through this mutual structure and lowering the cost of investing for everyone, whether you invest in Vanguard or you invest in someone else, you're probably investing at a cheaper price or a lower cost because of what we've done. And we're very proud of that. And we continue to try and be pioneers in that space, both across active and passive investing. So yeah, look, I think the final thing to say on this webinar from us is we're really, really proud to have been partnered with Fusion Asset Management, and we're proud that they've decided to invest in our product. We just want to give you a flavour for a couple of minutes around the product, the quality of the product. I'll bring Joao in at this point to kind of draw out some key pieces. I guess the main piece I would say is it's very, very competitively priced. You're talking 29 basis points for the retail share class or 24 basis points for the institutional share class. And you're getting a vast amount of diversification for that. Joao kind of touched on the benefits of global earlier on. I'll let him bring it to life now that just because you're global doesn't mean you can't do tight tracking.
Look, that's exactly it. And this is where it's important we talk about something that we've always been talking, but sometimes it can be misunderstood. OCF, the 24 basis points that Ben mentioned for our global small cap, 11 for global stock, that is what you can consider as your headline cost. But your true total cost of ownership is your tracking. How much are you deviating from a benchmark? That is your cost, because your idea when buying into a product is to get the benchmark performance, especially when you're doing indexing. So you haven't paid per annum, if you were holding this product 24 basis points, you'd have paid 7. That is our annualized tracking since inception for almost 8 years. 8 years where you had COVID, where you had stagflation fears, where you had volatility in the markets. We have been able to consistently deliver to investors. And this is something that we're very proud of, and something that we like to say, that it doesn't matter if you're looking at the large cap exposure with Vanguard, small cap exposure with Vanguard. We have a team that is super capable, a process that is historically been in place that is super structured, that we have a PM trader model, something super important, not that common. So the people that are deciding how to manage the fund are also the ones trading it. We have the model that is called pass the book. So for a global exposure, even though the fund is managed out of Europe, the traders executing the trades will be spread out across the globe because they have more knowledge about the local markets. They can trade using better, let's call it, opportunities based on their knowledge and history, also their specific algorithms. So we have been super efficient. It's a 4,000 securities exposure on the mid and small cap space. It's very hard to trade. That's why it's also more costly. You have to have their expertise. You have to have different access, different algorithms involved, and we have been doing a stellar job. Now, on the next slide, you will see what I was talking about, which is the stability of this tracking. First of all, I apologize for the bounces that you are seeing. We are using daily data because we believe it's a better reflection of the experience a retail or institutional investor will have. And in some days, the fund is close to trading and the benchmark is still pricing. Those big slumps around December, for example, Christmas and Boxing Day. And then because they are mutual funds, we have swing factors, so you can see some up and downs. But the importance in here is the trend. And you can see that both for our global allocation, but also global small, the trend has been consistent. What does minus 0.68% mean? It means that overall, have you stayed invested in our product since inception, since December 2017? That would have been your total cost of ownership, because it's the difference between the return of the fund, the return of the benchmark, and 68 basis points in total in almost 8 years is less than what you would sometimes pay on just an annualized basis for active managers in this space. So we are super proud about this, and it's something that we believe will continue. We would love for it to continue, and we have the right structure in place to keep it happening.
Yeah, absolutely, Joe. And I finished that point by saying, when you partner with Vanguard as a firm, especially from the index standpoint, we've been pioneers in this space. We've been doing it pretty much longer than anyone else. And I think that's an important point, because experience is one thing, but also belief in what you do is another. We truly believe in indexing. We did it when it wasn't popular. Everyone does indexing now. We did it when no one did it, when 2 or 3% of the market did it. Now maybe 40, 50% of the market doesn't. It seems like a logical thing to do. People have moved towards us on that. But we have the expertise, the resources, and the knowledge to back this up. And we do think that makes us the best in the world at what we do. And the proof's in the pudding when it comes to numbers that Joao's run through with you.
So now I'll talk about how we're actually using the Vanguard Global Small Cap Index Fund within our MPS portfolios. But first, I'll give a quick overview of the Fusion MPS portfolio ranges which we have available. So first of all, there's the Fusion Optima range. And for this range, we use the Fusion Systematic Strategic Asset Allocation. And then we construct the portfolios using passive ETFs. So here we're aiming to harvest risk premiums at low cost. Then we have the Fusion Active range, and this also takes the Fusion Systematic Strategic Asset Allocation, but then here we apply our own active tilts with the aim of outperforming the market. Then we have the Fusion Proactive Planet range, which is our ESG offering, and this is also built on the active range asset allocation, but then we populate it using ESG or sustainable funds. And then we've got the Fusion Passive range, and here we take an asset allocation which corresponds to specific risk profiles from a well-known risk profiler. And then we use the best performing, lowest cost tracker funds to populate the asset allocation. So here, the solution's perfectly aligned to the client's risk level at very low cost. And then finally, we have the Fusion Champions range. And this is where we blend the best performing multi-asset funds. So you end up with a portfolio which is built using some of the best solutions across the industry, but you also have that extra layer of diversification across strategies. So within each range, we have 5 risk-rated portfolios from low risk through to high risk, which caters for a wide range of clients' risk appetites. So the ranges which involve us making active tactical tilts, both the level of asset allocation and fund selection, is the active range, the Optima range, and the proactive planet ranges. And by tactical tilts, here we're talking about us making decisions to overweight a particular asset class, particular regions, or particular sectors, or to include specific exposure to a factor because we expect it to outperform going forwards. But one issue with factor investing is timing. So over the long term, the factors which Ben and Joao described in their presentation have been shown to drive investment returns over the long term. But factors themselves can underperform for extended periods of time. So if we look at a recent example of a theme, such as the Mag 7, where we saw the US mega cap tech stocks outperform for a couple of years, this is a recent example of a period where growth has underperformed value and large has outperformed small. So we haven't seen, for example, that size premium, which we talked about. So when it comes to amending our portfolios at our quarterly rebalance dates, first of all, in the investment team, we sit down and we formulate our market views and our global outlook And we also assess the likelihood of various scenarios happening going forwards. And then once we have our views, we then, again, we think and we identify which factors are likely to outperform given the market conditions which we expect to happen. So for example, at our last rebalance date in January, we saw an opportunity to increase our exposure to the size factor, as the conditions, in our view, were favorable for the size factor to outperform. So we saw that there was a decreasing rates environment. So rates have been on a downward trajectory from elevated levels for a while, which we expected to continue. And obviously, smaller companies are more sensitive to rates than larger companies, so they stand to benefit more from as and when those central banks introduce those rate cuts. So secondly, we were seeing uncertainty on the horizon for global trade, which is fair to say has certainly now been realised. So this theme of reindustrialization, a greater domestic focus, or deglobalization, if you like, led primarily by the US with Trump's America First narrative, tends to favour small caps, which tend to be more domestically focused and less exposed to global trade relative to large caps in terms of their revenues and supply chains. And then finally, as Joao mentioned, small caps are attractive from a valuation perspective. So smaller companies have been trading at historical discount levels relative to large caps for a while, so they could benefit from a mean reversion respect in valuations as well. So we identified that small caps were likely to outperform, or that size factor was likely to outperform. So we wanted to include a small cap exposure within the ranges, as I say, where we make these active tweaks. So that's in the active range, that's in the Optima range, and the ESG ranges. So within the Optima range, that's where we use ETFs. So we introduced a small ETF. Within the ESG range, that's where we use ESG or sustainable funds. So we included a sustainable small cap fund. And then within the active range, where we use mutual funds, we selected the Vanguard Global Small Cap Index Fund with weights of around 4 to 6%, depending on the risk level. And then we selected the Vanguard fund itself because its ability to capture the size factor, which Ben and Joao touched on in their presentation, we saw how the fund was able to capture this size premium historically with very high significance. We also like the diversification of the fund. So being a global fund, it's obviously well diversified across regions and also across sectors as well. And then finally, it's also low cost. So it's got an ongoing charge figure of around 30 bips, which is one of the lowest in the market for small cap funds, which is obviously one of Vanguard's trademarks, is that they have their sort of ability to charge low fees. And Ben touched on how their unique corporate structure allows them to achieve this. So hopefully that's given you a quick insight into how and why we included this particular fund within the Fusion active portfolios. And if you're interested to know how this choice has performed, or indeed how any of our portfolios across any of the ranges have performed recently, then please get in touch with us, as we're more than happy to jump on a call and discuss with you. Similarly, if you'd like any further information on Vanguard products or a copy of their slides, then please get in touch with us and we'll put you in touch with the guys there at Vanguard.
Very good. Thank you, Ben. Thank you, Joao. Thank you, James. Thank you, our listeners. I hope you found it interesting. If you have any comments, if you think what we should improve in terms of delivery, in terms of our subjects, which subjects you want us to cover, then please let us know. James will be coordinating, collecting the response, and enjoy the rest of your day, and we will see you all in a month's time for the next round. Thank you. Bye-bye.